The MACD is one of the most popular and broadly used indicators for Forex and stock trading. MACD stands for Moving Average Convergence Divergence because it requires moving averages as its input. The MACD is one of the simplest and most effective momentum indicators available. The MACD turns two trend-following indicators, moving averages, into a momentum oscillator by subtracting the longer moving average from the shorter one. The Moving Average Convergence Divergence is a relatively easy-to-use tool, but it's crucial to understand it fully before attempting to trade using its signals. Let's take a close look at the structure of the MACD indicator and its default settings. The MACD indicator consists of three components, namely two lines and a histogram. The MACD line is the faster line on the indicator. This line reacts faster to price changes and is more sensitive, moving above and below the second line of the indicator. The second line of the indicator is the MACD signal line. This line is slower and it gets frequently breached by the faster MACD line. We also have the MACD histogram. The MACD histogram simply represents the difference between the MACD line and the signal line. The bigger the gap between the lines, the higher the bars that the MACD histogram will display. If the two moving averages come together, they are said to be converging. If they move away from each other, they are diverging. So the MACD is a trend-following momentum indicator that shows the relationship between two moving averages of price. The MACD line is calculated by taking the difference between a longer period and a shorter period exponential moving average. Exponential averages are used because they respond more quickly to changes in price, since more weight is placed on the most recent price compared to earlier prices. You can use any length of period you wish when calculating the various exponential moving averages, although the 12, 26 and 9 period averages are most frequently used. To understand how the MACD can be used in trading, you first need to know how it works. This chart shows the relationship between the two moving average lines and the MACD for EUR/JPY. The top part of the chart contains the daily prices for the currency pair, as well as the 12 and 26 exponential moving averages. The bottom part contains the MACD line, the signal line, the histogram, and the zero level. Three things stand out from this chart. First, you can see that as the two moving averages move away from each other, the MACD line rises or falls. Second, you can see that when the two moving averages cross, there's a corresponding crossing of the zero level by the MACD line. Third, when the signal line and the MACD line averages cross, there's a corresponding crossing of the zero level by the MACD histogram. So when the indicator is plotted on a chart, the most important aspect is the interaction between the two lines, as well as their positions relative to the zero line. When the MACD line is above the zero line, it indicates that the shorter period moving average is above the longer period moving average, which in turn indicates that the market is bullish. When the MACD line falls below the zero line, the shorter period moving average is less than the longer period moving average, indicating that demand is more bearish than it was in the past. If the fast line is above the slow line, the MACD histogram is positive and plotted above the zero line, suggesting a bullish bias. On the other hand, if the fast line is below the slow line, the MACD histogram is negative and plotted below the zero line, indicating a bearish momentum. In general, MACD indicators are used in one of three ways: crossovers, overbought and oversold conditions, or divergences. Crossovers are probably the most popular use of MACDs. A sell signal is generated when the MACD crosses below the signal line, and a buy signal is generated when the MACD crosses above the signal line. In addition, the locations of these crossovers in relation to the zero line are helpful in determining buy and sell points. Bullish signals are more significant when the crossing of the MACD line over the signal line takes place below the zero line. Confirmation takes place when both lines cross above the zero line. Here are some examples of MACD crossovers. Using the MACD in this way makes it a lagging indicator. Just like moving averages, which are also lagging indicators, the MACD works best in strong trending markets. Both the MACD and moving averages are intended to keep you on the right side of the market, on the long side during uptrends and on the short side or out of the market altogether during downtrends. While you may enter a trade after the beginning of a trend and exit before the trend comes to an end, I would use this indicator as a buffer to reduce risk, not as the main signal. Another use for the MACD is to determine when a given security or index is either overbought or oversold. An overbought condition may exist when the price has experienced a significant upward move. At some point, you expect that the price might fall and return to some more normal level. Likewise, when the price has seen an extended downward movement, an oversold condition may exist. At some point, the price may be expected to rise to some normal level. A security or index may be overbought when you see the MACD rise significantly. During this period, the shorter moving average used in the MACD calculation is rising faster than the longer moving average. This is an indication that the price is overextending itself and at some point may reverse its course. When using the MACD to identify periods when a security or index is overbought or oversold, the best buy signals come when the MACD line and the signal line are below the zero line, as the security or index may be oversold. Sell signals are generated when the lines are above the zero level, where they may indicate an overbought condition. Unlike other oscillating indicators such as the RSI, there is no predetermined overbought or oversold condition. High and low MACD levels are relative, depending on the security or index you are examining. You may need to study the behavior of the MACD over time before you can determine when the price is overbought or oversold. Looking at the MACD behavior over an extended period of time, you may be able to discern patterns where the MACD may rise or fall to relatively similar levels, at which point the price will fall or rise. The third popular use of the MACD is to identify those times when it diverges from the price. A divergence occurs when the trend of the price doesn't agree with that of the indicator. In other words, an indicator trends in one direction, while the price goes in the other. MACD divergences tend to indicate a reversal in the current price trend. A bullish divergence forms when a price records a lower low, and the MACD forms a higher low. The lower low in the price affirms the current downtrend, while the higher low in the MACD shows less downside momentum. A bullish divergence takes place when the MACD is making new highs, even though prices fail to reach new highs. Greater importance should be placed if the price makes a new relative low while this pattern develops. Furthermore, both signals carry greater significance if they occur at relative overbought or oversold levels. You can use the MACD histogram to search for divergences, but also the MACD line and the signal line. The strongest signals appear when there is a double divergence on both the histogram and on the signal and the MACD line. Here are some examples of double divergences. This is my favorite way to use the MACD and the most effective way. Trading MACD divergences, if done correctly, can provide you the real edge in the market. It can be a powerful early indicator of trend reversals when combined with price action and support and resistance. Now, regarding time frame, there is no such thing as the best time to use the MACD indicator. This will be completely down to you, your personal preferences and trading plan. However, daily signals are more significant than 5-minute signals, just as weekly signals carry more weight than 15-minute signals. One common technique is to track the behavior of the MACD on a daily basis. However, instead of entering or exiting a trade based on a daily signal, you could refer to the weekly chart to see where the MACD is. For example, if you receive a buy signal from the daily MACD and you see that on the weekly chart the MACD is in bullish condition, you may wish to enter a long position. However, if the weekly MACD is in an overbought condition, for example, you will probably want to ignore the buy signal from the daily MACD. As always, if you learned something new, make sure you subscribe, click the notification icon, and leave us a like to show your support. Until next time.